Thanks, Sriram, for offering this program today about investing in real estate. We look forward to it. You can start.
Absolutely. Thank you. Thanks, Nari. Thanks for the opportunity. And let me start off, by saying I am not a professional in, you guys are like much more experienced, much more, in been in US, been in investing and everything. Just by virtue of, I have done this real estate in a particular model, and I happen to share that information with Shankar. So he brought me in and he wanted, I think people are curious. So I'm here just to share my experience. Whatever I learned during this process of investing, I've done like multiple of those things. So we can, I can go over those with you. So let's start off. This is basically about real estate investing specific to USA. This is not about India. India is completely different scenario. That is also, the REIT is also coming up in India, but in a very nascent stage right now. So when you talk about the possibility of real estate investment in US, you can do it in three types. One, either like what Bala did, you have your own rental properties. They can be an apartment like a condo, or a townhome, or a row homes like what Bala bought, like multiple townhomes, or even single family homes. And you can rent them on a monthly basis or in an Airbnb platform, and you can make money out of it. Both are possible in terms of the capital appreciation and rentals and all that. And the second is, if you don't want to go through all the hassles of owning real estate yourself, you can give away the um, logistics to a company or a person, and you can be an investor or a co-owner types. So that is either REIT, which is Real Estate Investment Trust, or you can do collectively, like we are now 10-15 people or 200 people in this forum. We all can get together and buy a property, and we would be co-owners. So that's what we are going to look at, these three possible options. What are the definitions of them, the negatives or the positives of them, negatives of them, and so on. And so the first option would be own your own real estate, properties, all this condo, townhomes, and so on. The positive, that there is no definition. You own, we all know that. So what are the positive of this? You can get all the profits yourself because you're not engaging another person. Even if you engage a property manager, when you have multiple properties, it would still be like paying him for his services. You're not sharing your profits with them. So you would retain all the profits. The negatives are actually, I didn't even mention what Bala went through. The litigation is a major issue here. Even before getting into that, there is no or very limited diversification. You have mostly knowledge on one particular location. I live in Boston. I know this market. Most of you live in Pennsylvania, so you know Pennsylvania market. Somebody else may live in Dallas and he knows Dallas market. But we do not know even Rhode Island, even Connecticut, even New York, New Jersey. So the diversification is going to be very limited when you try to do it. And even if you can go to other locations, the amount of money you would have or it will take to buy properties, you may not be able to buy more than in few of them in one particular location. So it doesn't give you diversification. If something were to happen to that location, that market goes down for whatever reason. For example, if we are going through this hurricane right now in Eastern Caribbean, that real estate in all those areas, Puerto Rico to Punta Cana to Turks and Caicos to Bermuda, that's the path it is going. This real estate is going to be affected for at least another year or two. People would be very fearful of buying anything there. So things like that, any of that could happen to any location, and that location, the prices would crash. Not only the whole market coming down, even specifically this, they could come down. And then that involves a lot of work from maintaining, arranging, and then showing in between tenants, like you have to get it painted, repaired, and all that. So unless you are willing to get your hands dirty, you cannot get into own real estate. Because if you were to handle like hire people for everything, that will eat away majority of your profits. And then
The one thing I want to add, Sriram, is like, I myself have done, I own rental properties, in many areas in US. In a way, I actually feel it's a diversification. So depending on how you look at the rental properties, see, see, there are many. If you're looking at a growth market, is different. If you're looking at a cash flow market, is different. If you're looking at a tier one city, is different. If you're looking at a tier three, so again, but I would say, like, probably diversification is there, but depending on the investor type, as an investor, how you look for, if you are more proximity to your own location, if you want to look within the 50-mile radius, then there are limitations. But if you always work with the
absolutely right.
turnkey providers, there are opportunities are there.
No, it is absolutely. I see. Not many people are as lucky as you are, Suresh. The amount of money what we can spend, or more majority of us can invest in real estate, is won't allow us. When I said no diversification, is practically I cannot have more than 4 or 5 maximum, I would say, properties. That is what I meant. If I have enough of a bigger of a portfolio which can accommodate, let's say, 10-20% of that portfolio in real estate, and that allows me, that part of it, that real estate part alone allows me to own in 10 different places, 15 different places, yes, then diversification comes. But how many of us would have that luxury or opportunity to have even 20%, even 30% investment in 15 different properties? That's what I meant by no diversification. Is that clear?
Yeah, I can share some thoughts, but I'll share some thoughts at the end of it.
Okay, no problem. So, you go through this, the vacancy issue, property damage issue, eviction issue. I was just telling you right before the recording, in a cold place like Boston, it's almost impossible to get an eviction from a judge in the winters. So if the guy doesn't pay, he damages your property, you still have to go through. And unfortunately, the laws in at least in Massachusetts, where I know, it's heavily towards the tenant and not the owners. Yes, with all that, if you are able to go through all that, yes, the profits what you can make from owning and the depreciation directly to you, they are not matched with anything else. It is what you want to do, like investing for, are we wanting to do like direct pick the stocks and do it ourselves, or engage an advisor and do it, that kind of a decision. Yes,
Yeah.
Suresh,
No, I
we
think
in fact,
this is a very good list, Sriram. I think one factor can play into positive or negative is appreciation.
yeah, absolutely,
Yeah, when
absolutely.
the market
Even
goes up,
even in
you
this,
get more money, but at the same time, real estate can have a downturn also.
absolutely, absolutely. And in fact, even in this small group, we have very, very contrary of opinion on real estate, like own real estate. Suresh seems to like it and then make it work, whereas Bala hates it now. So that's very individualistic. As for any like
Right,
any other
right. Yeah,
investment,
I
this is
think
also
you
very
need time,
individualistic.
right? See, you have put a lot of work, but also
Yeah,
associated with that is time. You're doing a full-time job and you're managing.
exactly,
Hats off to Suresh. If you're
exactly.
managing 10 properties, I have a couple of properties investment and it's a real headache. That
It
plumbing,
is.
that, this, and they call all the time.
No, no, see, yeah, no, I can give again. See, there are different approaches are there, but I agree with no, with Sriram. There are challenges and pitfalls, but there are also no opportunities. No, again, no, as you scan the market, you would know
Yeah, correct.
landlord. No, like you talked about Boston. I will never invest in Boston or Massachusetts because it's not a landlord friendly state. Is that right? So
It
when
is
you
not.
do investment, you also look at, no, there are many factors to that.
Correct,
How
correct.
do you,
Yeah,
how do
yeah.
you,
Let us look at all three options and
yeah,
come
yeah,
back for
Let's go ahead.
discussion. Okay.
absolutely, yeah.
Sure. Okay. So the next one is called REIT, which stands for Real Estate Investment Trust. This is more like mutual fund to a individual stock. For an analogy, for a lack of better analogy, I would say. Okay. And this REIT is nothing but a company which is formed like a trust to buy and operate profitable real estate, investments, commercial real estate basically. So they can buy houses, storage, uh, malls and shopping, anything, even hospitals, anything and everything commercial which can be rented. So it's a company which buys multiple properties and operates them. So when they operate, obviously they get the operational income which goes back to the investors, like in a very similar to how mutual fund would operate. And this is has got two kind of divisions. One is a publicly traded like MF and ETF. There are tickers, you can just say like best publicly traded REIT. You will get so many names including Iron Mountain and all that. So you can invest in them like any other, again like any other MF or ETF, and participate in the proceeds and sell it off like the way you would sell a mutual fund or ETF. There are privately, not publicly traded REITs are also there. Some of the big names, Blackstone, Broadstone, those kind of names, they are also there. They operate in a very similar fashion, but the only difference is they are not publicly traded like the other ones like Iron Mountain and all that. You can also participate in those REITs by investing with them. The only difference is they are all sold through financial advisor. Everybody is different, so you have to talk to your financial advisor or wherever you are holding the your brokerage accounts. There, get to know from them and then invest in one of those things. And they typically, unlike the publicly traded ones, they typically onboard and offboard once a month. Basically, the window to invest and window to withdraw open once a month. So on that particular day, and otherwise it's almost the same. Like they have NAVs, they have properties in it, they have dividends, they have appreciation and everything. The difference, maybe you can say like a closed-ended mutual fund, right? It opens on a particular time and then it sells on that particular time. So monthly you can either invest or take your money out. So this is about both the REITs.
So,
The
Sriram,
positives of
one question on
Mm-mm.
any advantage of investing in private vis-a-vis public, right? Public is easy, you can sell it anytime, buy it anytime. So what is the reason people go for private? Is it because of the financial advisor pushing it, or are there any advantages
No,
of private
no,
rights?
no. For an investor, there is not a really a major advantage other than the publicly traded ones can be sold any time of the day, any day, and
Right,
all that. With
right.
the private ones, you have to wait for that 1 month thing. But the quality of what I have seen with this Blackstone, Broadstone, SREIT, the quality is much better. The underlying assets are
Okay.
much better. They are much bigger. Um, see, it's basically like how do I put it? Like the ice cream's available in Walmart, and then ice cream in a classic ice cream shop. So they attract a different crowd. These Blackstones attract a different crowd, and they they bring in multi-millions to them.
Hmm.
And though those the offerings are far better.
And how about dividends? Like, do they pay also regular basis, private?
Every Okay, REIT by law, they have to pay 90% of their operational profits to the shareholders.
So that is
They
applicable to
cannot read
private also, private rights.
everything.
Okay.
If you register as an REIT, then you have to pay 90% of your operational income to the shareholders. You cannot retain and say like, I will buy more properties. It's not for growth. They can buy more properties with newer investments. They have to pay the operational profits back to the people. So everybody pays pretty decent dividends. Blackstone, I think about 4.5%, if I remember correct, to 6%, 7%, 8%, 9%. As you know, higher the returns, like higher the risk as well. So you don't want these people to take higher risk. And there is another thing, important difference between a good and a bad REIT. Let's say, like, I cannot uh, blanket say all private is good, all public is bad. The one of the factors which we need to take into consideration is what is the leverage they are taking, because to produce better returns, you don't want these companies to take very high leverage, like taking a loan of like 70%, 80% to buy a property. And if something goes south, these people will just let it go. They will not be able to manage those loans. So a good REIT like Blackstone, they hover around 45% to 50% leverage. So which means only 45 to 50% of the property value is in the loan. The rest is all ours, including their principals. So that's a kind of situation you want to be in, and not a very high risk taking fund manager per se to be dealing with your money. So leverage is something which you definitely need to look at. What is their LTV, the loan to value ratio of their property or the entire fund and all that.
Right? Sriram, this is Gopi.
Yep.
I was just
Yeah,
wondering, I mean, you mentioned the REITs, like they have to pay 90% of their profits to the shareholders. Is there a particular law, and how is that governed?
Good question. From what I know, they have to pay. I don't know from under which law it comes. Maybe I can just Google, and then I can send it to Nari. Okay, you can send it to every one of us. But that has been the norm, or even in India.
Yeah, I think that's what that's part of if when you want to form a rate, that is one of the rules that they have to follow.
Yeah, that's one of the rules you have to follow. You have to pay 90% back to the unit holders.
I just have a question. This is Kumar. So I don't know whether you know about this. There was I don't know whether it was REIT or something. It was called NRIA. They used to advertise a lot on Indian channels, and they built a lot of buildings in Philadelphia. And now I'm hearing they went bankrupt or something.
Oh, really?
Yeah.
Oh, wow.
Yeah, it is possible. It is possible. It is possible. I don't know about that particular case. In fact, you can see the next in the syndicate, the last negative potential loss of principal. It is possible. It is possible with this. And I know other names, but not this particular NRIA name. But it is possible. It is definite. And that is one of the reasons I was just talking about. You don't want the operator to take 80% loan to buy a property, because he gets 70-80% of the loan, and then he gets the remaining 20% from people like you and me. He has got no skin in the game.
Yeah.
Okay, so when there is a crash or something like that happens, until that point, the operator makes a lot of money through fees and all the other associated. They charge for everything, for buying, selling, maintenance, upkeep and renovation, everything. They make a lot of money with that.
Yeah.
And if something goes out, they just wash their hands and go.
I think this NRIA, I think they were guaranteeing like 20% or 14% or something, solid. That was one of the reasons I did not invest in that, because whenever you guarantee, when you guarantee a very high interest, the risk is also high.
Yeah, and they were saying they'll deposit the money on the first of the month in your bank.
Yeah.
And see, that is another thing which you need to look at. That all these points are more towards the syndicate I would be talking about. You need to see where the dividend is coming from.
Yeah, and also one tip for right. So because of the forced dividend ratio, it is always recommended to invest in REITs using your IRA accounts, which is a tax-friendly account, rather than your main main trading account,
Yes,
because
I've
then you have
written
to
that.
pay,
Yeah,
you
I've
have to
written that at
pay
the bottom.
tax.
Yeah, let's go with that. Let's go with this. So
Yeah.
the positives of REITs is very easy to invest and even divest.
Yeah.
So you can invest and take it out, and the investment amount is very small generally. Like any other MF, you can go with a very small amount, and then you can do SIPs and whatnot. So it's a pretty easy to operate, and generally they are has got a large collection of underlying assets across the country, even all the states, and across the property types, from residential to commercial to mall and all that. And the negatives of REIT is it is an investment. When I started, I just said it's like more like MF and ETF. So there in MF, you are actually kind of own the underlying asset. Here you do not own the asset, the underlying asset. You only invest in the company which owns the assets. So in the syndicate, we are all get together and buy the property. So we are all equal owners, whatever be the percentage. But here you do not own technically. So this is what happened in that issue where this person, even if they had that not under the loan and they had the properties, that NRIA thing, the investors did not get anything because they do not own anything there. And even in a good situation, not like in a bad situation, because you do not own, you invest, it is not a very tax efficient investment. Now Suresh can say this, by owning these apartments, he actually gets a lot of depreciation. He almost like writes off a major portion of that in 20 years, spread over 20 years. So your investment and the depreciation of the property and all that, so you get it directly. And REIT is to some extent tax efficient, but not as efficient as your owning or syndicate owning. Okay. And
Sriram?
because, yeah, go ahead.
I'm sorry. I have a question which may apply to both REIT and syndicated investment. Is there any difference with respect to the risk, whether the REIT or syndicated party is investing in commercial property as opposed to apartment, condominium, that type of thing?
Yeah. So personally, I have mostly invested in syndicates which are in real estate, like the properties, not like the 300 apartment complex, 400 apartment complex kind of a place. One thing I've 100% stayed away is ground up development. Everything happens, even for ground up development, this happens. Not in REIT, because REIT cannot be for measure of the government, because they all have stipulations. They should have certain percentage on income producing properties, so they cannot be like a lot of ground ups. But syndicate can be in ground up. But I've stayed up from the ground up development projects because there are a lot of things can go wrong with ground up. That's one thing. And I kind of stayed away from the storage and retail kind of a properties, because I'm not so sure, especially after the pandemic, I'm not so sure about the uh, future of the strip mall kind of small malls and all that things. So to answer your question, you have a better control in syndicate investing, because mostly they are like one or two, three properties, four properties, and they will have those are the identified, or they will be saying I will be investing in multifamily property in Austin, Texas. So you know what you're getting into. Whereas in REIT, like MF, you don't have any control. He can today buy Apple stocks, tomorrow he can sell the entire Apple holding. You have no say whatsoever in that. So in that aspect, there is no difference between these two. There is no advantage or anything. There in the syndicate, you can pick what you want to do. You don't like storage facilities, for example. So even though you like the company Christina or MG Properties or whatever, when they come up with a fund or a particular investment in a storage facility, you don't need to invest in that. Does it address, Vish?
Yeah, in a way, yes. But my basic question was, even though everything involves risk, if a syndicate decides to invest in, for example, student housing or health facilities, which are less risky in terms of what do you call not producing operating income compared to multifamily or even apartment complex, which are all residential. So that's what my question was more about.
Yeah. So in syndicate, you get to know what it is.
There are different real estate classes that Wish, like see multifamily.
It is.
Sorry.
Yeah, go ahead.
No, go ahead, Sriram. It's your session. Please go ahead.
Yeah, you're saying multifamily. Yeah, so go ahead.
No, I was saying see, Wish, multifamily, you can think this as a the bread and butter kind of thing, multifamily, but there are so many other different kind of syndications. Like there is a storage class, there is a senior citizen opportunity. There are so many different classes. But ultimately, it all comes down to the operator who is executing it. Is it right? That is where
yes,
it is the people are the subject matter experts, the longevity. So that is what is going to drive success, not just a simple syndication. Is it right? Depending on who is operating it.
Yeah, I've seen even mobile park funds, like, so they just only for mobile parks, right? They will have those mobile parks and operate it where people come and park an RV, they get the money. So it is different what we want to do.
This is Kumar. I'm sorry to interrupt, but this guy, I forgot his name, but he was with Donald Trump, a Japanese name, and he used to have like this big seminars on these mobile parks and how you can make money left and right in that. And I don't know where those seminars have gone now after Trump, but that was a very big deal this guy used to talk about.
See, there are good operators and bad operators in everything. Okay, and there are people who run those mobile parks very successfully. It is possible, but I don't know about that particular person. So moving on. So this is not a very tax efficient investment, and it is volatile. The price of the NAV of these units go up and down, and along sometimes along with the market, sometimes against the market, and this then at that point the liquidity will become an issue. Otherwise, it is a very liquid investment in a very down market like the 10 and 12 2010 2012 market. Even though it is you have the units and able to sell it like any other MF, you need to have a buyer to sell it. So that could be an issue in a down market. So this is about REIT. Now, syndicate investing. Syndicate is a temporary formation of a company or a temporary alliance of investors who interests are aligned. So here we're talking about different people. I like the multifamilies, and someone else might like the student thing. Someone might like the storage. So people who are interested in a particular kind of properties, they come together and buy. But in practical, what happens is, and the reason one of the reasons for that is like, if I go alone, I cannot buy the 300 unit apartment complex or 4 such complexes, right? So when we all pull our muscles together, it becomes possible, and that is the idea. But generally, it is done by an operator, as Suresh is saying. Like, you go through an operator, and that operator has got many years of experience in either building or maintaining or running these kind of properties, and effectively producing operational income, paying the loans, and then making the profits for the investor. So there is a particular operator like the REIT operator there. Here there is an operator. He collects money from investors like us, identifies a property, and he puts in some money, and the rest is from a bank loan, and he buys this. The most of the multifamily, like the apartment complexes, multifamily houses, they buy around 25-30 years old complexes, because that's where they can get the best cap rate, they call it, like for the amount of money and the rent against the rent of that investment. And they go and renovate one by one, from one apartment at a time. They complete it. The process takes around 5 to 7 years time, which is the typical investment period for a syndicate investing. At the end of it, all the units are renovated, and in the bargain, they have increased the rents for those 200, 300, whatever number of units. So as the rents increase and the properties are renovated, and along with the market, the value of that property from X to, let's say, X plus 25% or 30% or even 100%, at the end of the 7-year period, they sell and they give the profit back to the investor. They share the profit with the investors. And during that 7-year time, from the rent collected, the operational profit, they share with the investors like us, because the bank is like most of them are fixed rates for 7 years. So the interest doesn't, or the payment doesn't increase. And a lot of times they actually get a deal with only interest payable. So that is even a better deal for the company and the investors. And like REIT and your own real estate houses, they pay dividend either monthly or quarterly. So is that clear? The syndicate, is the concept clear?
But in the syndicate, there's no rule like they have to distribute 90% of the rental income or anything like that.
No, because you are actually collectively buying, which you are as much owner as me, or Bindu or anybody, Suresh or anybody there. So we are not giving anybody. We are investing, like we are buying together and we are taking the money out. That's all.
So whose name is the property under? When you say syndicate, is it like a company or a LLC or something you're forming?
Yes, it is SP, the special purpose vehicle. So every particular, either the property or the fund, will be a separate company.
Actually, you are a silent partner.
Oh yeah,
you are a limited partner. You don't take.
You are a limited partner. Yeah, general
limited
partner.
Yeah. So the general partner would be the main operators, and then the LLC will hold the company. So you don't get any liability as such.
Exactly. Yeah, and you don't get liability as well. But at the same time, you are a partner, limited partner, and while signing up and making the investment, they will take away all your rights. You basically sign up all your rights into it. Anyway, that is needed. It's not just that they want to take it or anything. Unless you are willing to go day in and day out, like Suresh said, manage it, then don't become a GP in anything. Even if it's offered, I will not take a GP.
So let us talk about the operator, right? So operator, how do you choose an operator? Like, do they have track record?
No. Before going that, there are a lot of things, Nari. Let's go with that.
Yeah.
One of the important things. So definition, we looked at it. Eligibility. This is one of the complex product and as well as a risky product. So the government said the most minimum you have to be an accredited investor to invest in these kind of investments. So when you say accredited investor, you can qualify to be an accredited investor in 3 ways. Either you have a $1 million net worth outside of your primary residence, everything else put together at least $1 million, or you make $200,000 a year for the last 3 years, or you and your spouse put together makes $300,000 for the last 3 years. So if you can prove with documents any one of these, then you can get a accredited investor certification. So I'm sure most of the people who are here will have at least one of them.
I think
If
in our
not,
group, most of them will be accredited.
most of them will have it. But there is a higher grade called qualified purchaser, where it is $5 million outside of your primary residence. So the difference is when you become a qualified purchaser, again the same what I discussed earlier. The deals which I have seen personally, what I have seen, which needs qualified purchasers, they have a higher minimum, and the quality of the deals are generally better, and the terms are also better. So if the limited partners, general limited partners, are given like 7% dividend, they are given probably 8%, something like that. So this has to be there to even think about investing in syndicate. If someone is not an accredited investor, then he cannot even invest in any of that. And the positives of that is the returns are a little better, and it provides like any other properties you own yourself. It gives you quarterly or monthly dividend and the capital appreciation on the properties which you underline, you own. And this is an ownership, not a simple investment. You are a co-owner with limited rights and all that. And this is a better tax efficient investment than REIT, because at the end of the year, like any other company or anything you own, they will be giving you a certificate. In this case, the certificate is called K1, like your 1099 W2. It is K1. Negative K1, I've written this because most of these operators in practical, they give a return, the K1, which has got negative return. So with depreciation and all that. So this generally works for people. There is no rule or anything, or it's not 100% all the time and all that, but practically that's what happens. So they have the apartment, they are spending on renovation and all that, and then the depreciation, I don't know how, but 99% of the time they give negative K1. So which cuts into your taxable income. And this is generally like one property or a collection of few similar properties. Very rarely you will see a fund which has got everything in it, from California to Maine, from residential to commercial to everything. They are, most of them, they all have their niches. Either in Los Angeles area, that's their niche. Someone else's niche is residential apartments in Dallas, Texas. Someone else's is college houses for the students in Arizona place. So mostly they are specialized properties. So whatever you want to do it, you can do it. As Bish said, he's like that. I like this. Someone else likes something else. So you can do that. The negatives of this is the most minimum for a decent syndicate would be $25,000. A lot of them are $50,000. A lot of them are 100,000 or even more. Some of them are even like $1 million. Otherwise, don't even come to me types. And these are highly illiquid. In my entire portfolio, this is the most illiquid asset I ever own. Until the guy decides to sell the property, you are not getting your money back. And generally it is 7 years, they call it. And they also have the rights to extend it if God forbids and the market is very bad at that time, they'll extend it. So you cannot sell as per your whims and fancies. You have given that right to him. You have to wait for him to sell. A good operator has got history. He is always sells it at the right time. Even though they said 7 years. Another thing, like you may not want this particular profit coming in year 4. You may have something else planned on that particular year or whatnot. But you don't have the control. Not only on the bad side, even on the good side. They have identified a right time to sell at year number 4. They will go ahead and sell. They will not wait for your approval to do that. So you may end up getting the money which you did not want on year 4. That's also possible. So, and this requires a lot of research and due diligence, because this is not common knowledge. You do not find this on finance.google.com or yahoo.com. I get to see what is the stock price today, NAV today, and all that. There is nothing like that here available. So you need to do a lot of research, have a group of people, share their experience and all that. So unless you are willing to wait and find a lot of research and all that, this is not a good idea. And the potential loss of principal is very much there here, because we have come across fraud operators. We have come across people, who were on SEC guidelines issues and all that. And even simple mismanagement. They spent a lot, they hired someone wrong guy, and it's all possible. So now comes to what
Sriram.
yeah.
Sriram,
Yeah, go ahead.
sorry. One question about the negative K1. The negative K1, can it offset, if there's a negative K1, can it offset the profit you made in selling stocks or ETFs or mutual funds, or this is
Yes.
limited?
No, this will offset the capital gains.
Now, I was told by my tax advisor only particular situation it can come into play, not offset general capital gain. I don't know. I understood it.
It won't go. See, the tax depreciation is. So let's say if you're paying $25,000 as a limited partner, depending on the operator, some operator would give you 100% depreciation. Some operator would give you 80% depreciation, because typically the fund goes in for renovation, and then buying the property is kind of a bank funded, is that right? So typically you get a depreciation, but that's a separate swim lane. You cannot really take that and then swap it against the stock profit. What happens is,
that's what I was told.
No, that is right. No, it is a tax deferred. It's a tax deferred no plan. What happens is next year, let's say if you have a preferred 8% return, and then if there's a cash flow of 8% that comes through the rental, like the way like the way Sriram explained. So now you're getting 8% of your capital investment. Is that right? So you don't pay taxes on that, because you already have your depreciation. So you're going to kind of swap that cash flow, over a period of time. So you end up won't paying any money till a point where you're going to make a net profit. Let's say if the net profit is basically, that operator choose to sell, like a 3-year, 4-year, 5-year, depending on the good operators, is that right? Then let's say like, you're making 2x the money. So all of a sudden you're going to make $50,000 on the investment that you made 4 years back. Now the $50,000 is completely going to be subjected to tax. Is that right? But then you have to be smart enough to use something called as a 1039, which would basically, you will invest the whole 50,000 in an equal like to like investment, and then you can continue to keep pushing your tax till at a point where which year you will end up making the lowest income. It has got it's kind of a jigsaw puzzle, is that right?
So essentially, then the
It is.
bottom line is what my tax advisor told me was, as you said, whoever responded, that negative K1 cannot offset the yearly profit in selling stocks or ETFs. However, this negative K1 accumulates until the property is sold and you make money, then it will offset the capital gain of selling the property.
Yeah, that's right. That is the way it works. That's why I said it's a each of those K1 is a separate swim lane on its own. The only thing is, like, as you make your distribution year on year, when they make the rental, you don't pay taxes on that till you hit the $25,000 mark, or 50,000, whatever you invest.
Yeah, okay, that's what I was.
See, you have one option for that. You have one option for that, Wish. For what you're talking about, there is a different option in the syndication. I'm not mentioned that in that at all, because we're not talked about tax partially. I'm not even a tax expert or anything. There is something called QOZ funds. Companies like Origin funds, Origin Investments are offering that. Many companies are offering. Origin is the most famous in QOZ funds. That helps you offset the capital gains even from stock. So if you had stock appreciation this year, you can invest that in that QOZ funds, and that will allow you to offset the right in the same year.
Yeah, but there's a catch there. You have to invest within 180 days.
It is, we have to within 180 days. That is one thing. And no, that is, you can do that. The problem is, like, again, see, there is no free lunch, right? It is kind of a tax deferred. not
Yes.
really tax free.
Yeah.
Okay.
Yes.
Even QIC funds, when they become mature, they are become taxable. And as you know,
No, they're
Suresh,
tax
right?
free. When
So,
they mature, they are tax free.
no,
But
no,
you,
yeah, the QIC funds are tax free. Sorry, QIC funds are
yeah,
tax free. Even in 2030, right now, the ones which actually my friend invested, they become 2030, actually it's tax free. In
yeah.
2030, it is tax free.
But right now you can defer your taxes for 5 years till 2026.
Yeah.
You can defer the taxes till 2026.
And in this individual funds or investments, yes, you can park your fund in a 1039 place, and then you can, from that you can fund another
Yeah,
purchase.
the
You
1039 has
keep on
got a time
doing it.
limitation.
Yeah.
1039, like
Yeah.
you can't just keep it. No, that is, I think it's 180 days or 90 days. No, I think it's
180
90
days. 180 days.
180 days.
180
I
days.
think
Yeah.
you guys are mixing. It's not 1039, it's 1031. And
Oh, sorry,
1031,
1031.
1031 exchange, you cannot just willy-nilly do it because it has to be like for like, and it has to be in the same entity in which the property was purchased and sold. So if you are in an LLC, all the members of that LLC have to, because that LLC has to now buy the other property, which all investors may never agree to, because some may want to exit and say, I'm not interested in investing with you.
Yeah.
So that becomes a challenge. So typically 1031s are very popular when you are owning individual properties, or you and your spouse or someone or a close knit group of investors are owning it. And that's their long-term strategy to kind of basically keep rolling into new properties, sell and keep, it's like you invest, refi, and then die. That's the story behind 1031s.
Yeah.
So
Sorry, no,
there's a
I
term,
said
right, Sarpa?
1039. It's actually 1031.
Yeah.
Yeah, that's right.
Sarpa, there is a famous term for that. Tax deferred until die. Like what do you remember?
Yeah, refi till you die.
Yeah.
Refi till you die. Refi till you die. Correct. Refi
Yeah.
till you die. Yeah. Yeah. So I think so. Anyway, so coming back to this, so where do you find such offers, like the funds or particular properties? One place where generally people start is a marketplace like crowdstreet.com or equitymultiple.com. Crowdstreet.com is the most famous in that. You can see a lot of Indians getting in there. In my opinion, that's where you see the lowest grade decent offerings. Anything less than that is, I wouldn't even consider, like ground up and loans and all that. There are a lot of things like that. You can even just loan people for renovation. They are very high risk. CrowdStreet has got at least some decent operators coming in, and most of these investments would be $25,000, and almost invariably everything is accredited investor. I've seen just like one or two qualified purchaser requirement in CrowdStreet, but 98% is accredited investor. Then you have
Sriram, is there like in addition to CrowdStreet or something similar, like are you familiar with Realty Mogul?
say that again. What's the name?
Realty Mogul.
Yeah, it's
Realty
kind of
Mogul.
the
Yeah, Realty
same.
Mogul. Yeah, Realty Mogul. I have an account there. I don't have investment, but I have account like in most of these places, like Equity Multiple, Realty Mogul, and all that.
Oh, okay.
So that's what I said. Marketplace. Once you go, you can find a lot of marketplace. CrowdStreet is the most famous. Realty Mogul is one. Equity Multiple is one. You can see.
Cadre is there.
Yeah, Cadre and Origin Investments is in a little different way. They are more of a funds, not a marketplace. They are more of they create funds like with multiple opportunities in it. So Origin, they keep giving either an income fund or a QOZ fund. So where QOZ is for people who wants to defer their taxes, and the income is towards the people who want regular income stream. So those are two offers. Like I think one is 50,000 minimum, one is 100,000 minimum. So that is where you can invest with them. And
Yeah, I
Origin
think
Investment
Fundrise is also in that kind of.
Fundrise. There are so many of them. There
Yeah.
are so many of them. Okay. Because once you see somebody successful, you see people popping up all the time. Okay. And then you have other places. There are a lot of good, very old operators. I just given the names which I know of, and there could be so many more. MG Properties, Christina, they operate out of California. They are 30, 40 years operating companies, and they specialize in Los Angeles or San Francisco area. These people, MG Properties, they have not lost an investor money for 40 years.
But
So
Sriram,
every
one question I had for you for these like California-based property owners in these kind of groups, don't you kind of struggle with the tax returns and the California income tax and the local income tax, the high rates and all? Don't you find that disadvantage?
It is. See, it is. That is what you have to look at every single aspect of the deal before you make a call, right? And if I have to, I talked to somebody in Massachusetts. There is an operator in Massachusetts, for example. I met him in a Crowd Street meeting, and they claimed 25 years of experience. So then we asked for his track record. And the guy said the owner actually worked for a company for 15 years, and now that is closed. Now we have taken it over. So this company's history is 5 years here. Where is the remaining 20 years? The 15 years. So they had some issues. So that's why they had to close. And then, so that is where, I would rather go to a, I don't know when you joined, like before we started, a very conservative guy. I would, I'm okay with getting 2 points less, but where my money is 20% safer. So that is where my point is. So again, these are names. These are very well-known names. There is no doubt about it. And they have been operating for a long time. They have been taking care of the client money. How much do you end up making? That's a different question. So you can look at this particular offering and their track record and somebody else's track record and see. I have invested in a Dallas-based company. That was my first real estate deal here. And surprisingly, Ashcraft Capital. I did not put that name, but Ashcraft Capital. In last 3 years, I think, he is the only one who pays me. I just put in 25,000 there. Month after month after month, the guy pays me $166, 8%. No one has ever paid that much. But that is not a company which I would put in $100,000. Because this guy has got a much better track record, Christina or MLG or MG. Grub, Claremont, Shortis, everybody, and they all have different things. Shortis has even got a, in COVID, I think he started distressed property. So if that is what you're going for, go for Shortis distressed property fund.
Have you heard of Nanban Realty and Orion Re, I guess?
Well, what is that?
Nanban Realty.
Nanban Realty. That name sounds ring a bell.
Yeah,
I don't know.
Gopala.
Nanban based out of Dallas, I guess. I think Texas.
Yeah, it's Dallas.
Yeah.
Okay.
Nanban in Tamil means friend.
Nanban is friend in Tamil. So
Yeah.
I'm not, but I've looked at them, but I think somewhere maybe I've seen some poster or friend something forwarded something to me. I'm not sure. There are a lot of things, and there is another guy called Neil Bawa is actually doing it. Pretty poor offerings in my opinion.
There is another guy. He advertises on CNN. I mean CNBC. Indian guy.
Nithya Capital.
Yeah. What do you think about that? Nithya Capital.
No idea.
He stopped now. So.
Oh, is that?
Yeah, those are advertisements stopped. Yeah.
Yeah. So, Sriram, I had a general question on real estate. Now that interest rates are going up, right? So this syndicate real estate investing also requires a lot of bank loan and other things, right? Mortgage.
Yes, it is absolutely.
Yeah. So what is the prognosis for the whole real estate?
See, I have kind of like put pause on all this real estate because it is not something which I really did on my own or anything, but I happened to start investing at the right time, and I all my investments were made when the interests were very low, and all those guys were fixed for the 6 year, 7 year, 10-year period. Okay, so right now, whatever is happening to your individual, even personal home buying, the same thing is going to happen here as well. It is going to cost more. There is no doubt about it. If you are taking like $1 million for your personal home, these people are taking $200 million for their property fund or their particular property. So it is going to cost them more, and it is going to cost either the buyers or the renters more, and to some extent it is going to affect your dividends as well, because it is going to affect your the operational income. And the reason I also stopped is like the prices went crazy right now. So anybody who's buying house today is paying top dollars. 7 years down the line, I'm not sure if it is even going to be the same price. Forget 2x or 3x.
A follow-up question on that. Suppose say you invested in Syndicate or whatever, or REIT. It's a mainly Syndicate. Before the interest rate started going up, and but these Syndicate people will be buying properties continuously. So if a new Syndicate comes, they cannot mix that with the old one. Each one is separate entity. Am I right?
Each one is a separate entity. SPV, they call it, like special purpose vehicle. So it was a separate company in which I was a part, and I made it. Then done. Like even if the same operator were to float another one today, if I am not participating in it, I have no issues. I am not exposed to that rate or anything there.
Okay, thank you.
Okay. So again, this can be for residential, commercial, industrial, medical storage, or mix of them as well. So it depends on what you want to pick. You can have a look at it and then pick. Okay. So how to identify? That was Nari was asking for. I will start up personally with the operator history. Like how long he's been there? Who are the people behind it? What are their experience in real estate? Typically, these people would find like the owner operated, and the owner has been in real estate for 30, 40, 50 years, whatnot. So that is the most important thing I would look at it. Then I would ask for the historical transaction details. They all have this. They will give you some of it, mostly like last 2 years, 3 years, 4 years. So anything which is unrealized, like other than that, I would want to see the entire realized sold properties from their inception, and we have to see how many times they have lost money of from the investors. So that every list, if you see, that column will be there: the purchase price, sold price, hold time, and what is the IRR made for investors. So 15%, 10%, 20%, negative 4%, so that you can see. And another important thing is I would definitely look at least 5 to 10%. 10% is what I would normally look. Of the entire project, the operator is investing at least 5. If it's like $100 million project, and he gets LTV, is that it ultimately boils down to LTV. What is the loan? 60%. 2/3 is what ideally I would like to see. 66%, and the remaining from the 33%. 20, 25% from the investors like us, and the rest the guy puts in. That is when he will stay invested in good and bad times. Because until that point in time, I was just telling earlier as well, they make a lot of fees in maintaining, buying, selling, and all that. If he does not have a skin, then it would be very easy for it to just let it go and then say it funked. So that is something which is very important for me to see. And what are the waterfall? Waterfall is basically the profit sharing model. They always have thresholds. So up to 10% or something like that. So it is 100% to the investor. Normally it is 7 to 8%. I'm just giving an example. So up to 7%, it is 100% to the investor. And then they start kicking in 70, 30, 60, 40, something like that. So I would want that to be as low as possible, right? So you would want to get the maximum profit. because they already get paid for the work and everything they're putting in. And the properties they are investing in, which we already discussed in length, what kind of a property, which location, is that location I would like to be in, Massachusetts, and all that things. Okay. And if it is a fund that, is creating a fund of residential properties or whatever, then I would look at what kind of a properties is he going to buy ongoing, residential and things like that. And then they always have these financial statements in that offering, which you go through in detail and see what's the numbers look like in terms of cap rate, in terms of renovations, do they even look real to you, and all that. And obviously I would look at the fees, what is the fee they're charging for stuff, and then compare it with other offers. And I would also, this is very, very few of them available, but you can still see, like Google, just see what reviews you have on those operators, and see if you can come up with some any flag. And not only reviews, user reviews, when you try to Google, you will also see if there is any SEC violation, any ongoing investigation or anything like that you can see. And this is a personal choice, not for anybody. I will not invest in a ground up development, which for the reasons I explained earlier. Any questions?
I'm very sorry. I did not hear your reason for not investing in ground up. Can you tell, like in probably like 30 seconds, what the reasons are?
Oh, yeah, sure. So put it very simply, this is Suresh, right?
Kumar, Bindu.
Bindu, the chances of things going wrong in a ground up development is much higher than an existing property. Simple as that. The property can be delayed for so many reasons. The prices may go up, and invariably, at least in my opinion, my experience, I've seen nobody finished a real estate, like a house building project, with the same cost in mind when they started. Simple.
Yeah, that is true. Okay.
Yeah, I'll agree with Sriram there. Speaking from personal experience, there have been some good deals and some bad deals, and especially during COVID, there was so much fluctuation in the prices, availability of materials. Now you have issues with finding windows, garage doors. If you don't get a garage door, you cannot get an occupancy certificate. So the house is ready and built. And I hear so many stories that, the garage doors are not available for months and it's just sitting there. Finance is tied into it. You're losing money because you have to pay the interest on the construction loans and stuff like that. There are too many moving parts. So you really need to be like a really experienced sponsor who can kind of manage those kind of risks and kind of come out ahead. So there's a lot of challenges in today's day and age with ground up, or there's a big niche starting out in the build to rent space as well. It's catching up a lot, but again, those are not fraught with risk for timing and stuff like that.
Satpal, wouldn't that be the same issue with, like if you acquire properties, to renovate and then sell?
Well, but it is still cash flowing, right, Gopi? So you have something already in place. It's not like it's vacant or whatever. You have an existing cash flow. You're trying to build it up little by little. It's a stage approach over a 2-3 year time frame, but they are cash flowing to some extent. It's not like you have negative cash flow, right? It's just the depreciation that's making it negative for the most part, but they are kind of giving you cash flow from day one for the most part. Some cash flow. They may be giving 3%, 4%, 5%. They are generating somewhere something. If you're doing like a ground up, you may not see anything for 2 years, 3 years, depending on the size of the development. Small deals maybe you can get within a year, but the bigger deals and all, like the apartment complexes, they're typically 2 years out, and then you don't see anything, right? Your money is locked in, and then there can be so many
Only
things.
slabs. The other thing is, Yeah, and these apartments like generally have like 100, 200 units, and they take it over, and then they start renovating one by one unit at a time. And then if you come across an unfavorable situation like what we are facing today in terms of supply chain, they can choose to pause the entire renovation. Just let it run, continue the rentals. On the other side, here you have no choice but to go ahead with the construction, whatever be the price. And if you stop, that's going to cost you more. And then today you have an assumption in the existing unit, it is $1,500 per unit, and it can go up to 1,600 or 1,700 when you renovate. Now, in the ground up, you are looking at 2 to 3 years from now, and you are making an assumption it's going to give you $1,800 rent, but you don't know what the rental market at that time is going to be. And that's when I said it's too many moving parts for me. Personally, I don't like it. So it is not a rule or anything. I'm not suggesting to anybody, but that's a personal choice when I identify the deals.
Yeah, no, this is great, Sriram. Very, very good information. And I will stop the recording now, but people can continue to ask questions.